Hi, everyone. I'm Rick Bensignor. Today is Tuesday, March 17th, and welcome to In the Know Trader. Well, it has continuously been wild markets day after day for the last 2 weeks with massive moves that are basically unprecedented for intraday swings. And although the largest percentage loss ever was still back in the crash in 1987 when the Dow lost a little over 22% in the day, we're starting to see some rivals of that with 10, 11, 12, 13% moves in the market very recently and just massive intraday swings. So we are dealing with stuff that most of you have never seen before. I've only seen, minimally in my 40-year career. And it takes nothing now to move the S&P 20, 30, 40, 50 points, literally minutes on. When you think about this, and a lot of people haven't put this two and two together yet, but think about the type moves we've seen in the last couple of weeks on a closing to closing basis. And compare that to the fact that the average annual return in the market, if you go back 50 to 100 years, the average annual return is somewhere around 7% a year, give or take. And we're now doing that daily. So we are moving in a day what has been the average return, basically historically in the market. There's nothing to compare that to. And therefore, you know that even with like In the Know Trader, our weekly piece, last week I was saying that you really shouldn't be trading the market unless you're in front of your screen all day. And the reason I say that too is think about the traditional way that people use stops. And you could pick a raw price and just say if it ticks under a particular price, you're stopped out. But the way the market's moving now, chances are you're going to get stopped out. If you use a close-only basis, which is typically what I've used in the past, if you wait for a daily close, that could cost you an extra 200 S&P points worth of movement. In other words, you could lose an extra 10% from where you thought you'd stop yourself out just simply because you waited for the close of the day. So that's not really an effective way, which basically means that unless you are a very adroit short-term trader, that you really have terrific skills in doing this, you can't be involved in the markets now other than positioning for the longer run and understanding that you could buy something on any given day and the market could easily be 20% lower in a week from then. But for the long term, you're looking at thinking of, okay, well, maybe there's some good places to get into some stuff. Even the charts we looked at last week have moved so dramatically. Take, like a Boeing or something that last week was, I think it was somewhere in the 170 range, 160 range, and this morning is down to 110 or something like that. So even I bought some earlier, I can't remember if it was this week or last week, in the 160 neighborhood and, getting killed on it. But I have to hope that Boeing's not going out of business and that it's going to take me some time to obviously get this back. But that in the long haul, there's some value here. So we're going to do things like this week's show is going to be a little different than the past. Not so dissimilar, but we're going to kind of just get into the charts because I think the most value I can give you when the markets are moving like this is to simply give you levels that may be important for where to look to put on or take off some positions. And that's probably the best thing I can do. So we'll look at the S&P and we'll talk about that for a few minutes. And then here, let's see. We're going to even skip how to contact me. We'll go back. So this is, these are the names we looked at last week. I'll probably take a look at most of these again, just because these are very favored names, and just take a look at, what's going on. not only in the S&P, but essentially across the four asset classes. So in that case, that's why we'll look at the TNX, the 10-year yield, and the IEF, which is the best way to trade that. GLD for gold. Not that probably on a percentage basis, most of you are not in the oil market, but given how important oil is, we can take a look at USO, which is the ETF that tracks the oil market. DXY is the US dollar index. That is not actually a tradable index under that ticker. That is simply the index. You can trade futures of it. There is UUP, which is the ETF that is captures the upside of the dollar move. And I think the flip one I'm trying to remember is UDN, but I might be wrong on that. I'll have to look, but that's kind of the bearish dollar. So if you buy that, you're bearish the dollar. Then of course the Mafang names, and we'll take a look at a couple of the big banks, and we'll look at Boeing, and we'll kind of go through what we looked at last week. But notice how big the moves are, and more importantly is kind of getting a sense of what's going on out there. And is the mentality of buying the dip that has worked so well in the past still something to do? Or are we going to be in for years of kind of a total repricing of the market? And what we saw just a month ago is the all-time high that is just shy of 3,400 in the S&P. How long is that going to stay the all-time high? How many years will it take to recoup what we have just declined in a matter of a month? And is the answer that we'll see new highs later this year, as a few people think? But that's certainly tough to right now think that can happen. Or is it going to be something that happens in 2021? Or is it going to be something that takes 5+ years to be able to re-hurdle this, because of the massive repricing of risk of assets right now in the marketplace? So these are things that, as investors, we need to think about as we move forward. So let's start off. Let's move to charts, and here we go. So here's the S&P, and I'll use this as a pointer. So notice there's two. This is a long-term chart. This is a monthly chart. So this trend line goes back to the 2009 low. And I had put out a note to clients, I don't know, maybe an hour ago or so, my institutional clients, talking about why today is a day that you should do some buying. And I talked about the obvious things and the non-obvious things for why I came to that conclusion. Here's the obvious stuff. We're bouncing off of the trend line from the 2009 low. So if you connect the 2009 low to the 2011 low, draw the line. We went a little bit beneath it, but on a monthly basis, we know there's some long-term support here. Secondly, I drew a horizontal line to the 2018 low, the Christmas low, that, we had that bad fourth quarter in 2018. And then, we shot up to, again, all these are all-time highs. And then, of course, the 2-month collapse that has encompassed both February and March. So we basically got very close to that so far this month. The month's not over, but you can see we're actually looking at real time now at about 11:20 in the morning Eastern time, and the S&P is just about at 2,500. So, we've bounced a fair amount already today. So those are the obvious things. Then take a look at a monthly cloud chart. We've come right into the long-term support level from the monthly cloud chart. So for those who know Ichimoku, you might have said, okay, well, this is, somewhat obvious as a place to buy. Then also from the Ichimoku chart, this bold blue line is nothing more than where the last price trades on a continuous basis. So it is the exact value now, 24.98, that the market is now, 24.98. So it simply moves with the market. But at the end of each month, think of this as a line chart. So when you see a move down here and an up move, that's a monthly close here, that's a monthly close up here. In real time, it's going to move with the market, but at the end of the month, it prices itself. Well, in real time, when we got down to 2367 this month, and I'm pretty sure that was today, this lagging line was down to 2367. And there is actually a support level here at 2341. So we got 1% away from another piece of the cloud model that suggested potential support. So that's the obvious stuff for why to be a buyer today. What's kind of some of the non-obvious stuff? Well, one of my favorite, actually, it's not one of my favorite, it is my favorite sentiment poll, is something called the Daily Sentiment Index. And it polls non-professional futures traders, what if they're bullish, the, I don't know, roughly 30 or so different futures markets that exist in the US. So, every day it polls people who are part of, let's call them pollees, people who are polled. And they simply say if they are bullish a particular market. So it goes through all these markets, whether it's oil, gasoline, natural gas, gold, silver, copper, the S&P, the treasuries, the grains, the cattle market, the cotton market, the orange juice market, etc. And the people who are part of this poll simply say, yes, I'm bullish, or they're not. And so when you get readings above 85% bulls, you tend to be towards extreme readings. And that doesn't mean you can just sell something because it's 88% bullish, but you know that you really have a stretched market that has been moving higher. And when you get under 15% bulls, you know that you're looking at a market that's getting trashed. And again, I can't buy something simply because I have a low DSI number, but what it might do is start me looking at reasons why or where you might get a bounce from, that too many people are bearish. Well, coming into today's session, so the poll taken after yesterday's close, Monday the 16th's close, was that there were only 4% of the people polled bullish the S&P. The all-time low for that poll was on the evening of March 9th, 2009, when only 3% of the people polled were bullish. And that is part of the reason I was able and put out a very big call on the morning of March 10th, 2009, that Jim Cramer on CNBC talked about, and it was all over the press that I had turned bullish for the first time in the entire decline from all-time highs. And part of it was the fact that there were only 3% bulls. Well, coming into today, there were only 4% bulls in the S&P. So now, knowing how few bulls there were in the S&P coming into today, and then looking at this stuff that to me, I put into the somewhat obvious category of why we could have been a buyer on weakness. And I actually put the note out when the S&P was trading lower this morning, was simply because of a combination of looking at this and knowing that only 4% of the people polled were bullish. That basically means there's nobody left to sell. Everybody has sold. So I put this note out. But there was another element to it, and we're going to take a look at that when we look at the daily chart of the S&P. And what we see here is that today marked the first time in the decline that we're getting an exhaustive signal from Tom DeMark's combo model. And this is actually aggressive combo. So I made the 13s come in. This is the most aggressive count of getting to a 13 as fast as you can. Now, in a market falling out of bed like this, that doesn't mean I think it's necessarily the bottom. But it certainly was enough for me to say that today will be a day that you could buy with an initial target somewhere around 2650. And I don't mean that we're going to get there today, but then again, these days you just might. So by the time you're listening to this later in the afternoon, when this comes out at 3 p.m. Eastern time, for all you know, we could be there. And for all you know, we could be 200 S&P points lower. I don't know. But to me, it made sense that this was a place to take some idle cash and put to work, and play with. And it is playing with, because this is gambling at its best. Um, but this is a place to me that made sense to take some idle cash and put it to work. Um, and that doesn't mean, again, that this is the bottom. This doesn't mean that I think we're going, up to 3,000 in the S&P. I don't know, just like you don't know. What I do know is, to me, it made sense to do some buying here. So when I combine a DSI of only 4% bulls, an aggressive combo count, and by the way, I'll show you just, if I use traditional sequential, which is the sister model, not trying to be aggressive or anything like that, and I turn that on, then today is, well, hold on, today is only a 6 count towards a 13. So it would say that in a standard sequential, we're not even close to a bottom, but that doesn't mean there isn't potentially a trade here that makes you some money on the upside before selling comes in again. So I see that we have a propulsion exhaustion level at 2653. I see the clouds conversion line coming down. It'll drop again tomorrow some more. So those might kind of come together, and that would be what I would say is probably first level resistance right now is there. And, it's kind of amazing to talk about hundreds of S&P point movement as just being first resistance. But when you're moving 200 S&P points in a day, as we have multiple times recently, that's what the market is. That's what we have to play for. Used to be 200 S&P points. If the market moved up 200 points in a year, it was a pretty darn good year. Now we do it in, 2 hours. So that's of significance, and that's why I'm doing some buying here. If we go back to the monthly chart, let's say we break these lines. Where's next support? Well, the bottom of the cloud, and that would not be this month. If it happens this month, the bottom of the cloud is all the way down here at, let's say, 2477. Next month, it looks like it's 2305 and stays there for a couple months. So that's potential support too. But you also have to know that when markets get this erratic, yes, you can use, I do not throw technical analysis out, but you have to give lots of leeway. And before you put capital to work, you really have to ask yourself, how do I stop myself out if I'm wrong? If you're looking at a monthly chart to make decisions, then in theory, you need monthly closes underneath certain levels to say that it's a good idea or it's a bad idea. Right now, my idea to have bought this morning is good because the S&P is up, I don't know, 60, 70, 80 points above where I suggested you buy it. But again, these days, that's 15 minutes of trading. I can't know at this point if the month of March is going to hold this level. And I certainly, let's say it collapsed. Do I want to wait? Let's say we close down at 2100. Do I want to wait until the end of the month to decide that the cloud's not going to hold? That's the difficulty in trading now. So part of this is thinking to yourself, how do I manage risk in basically a market that's not letting you manage risk? So that perhaps is the most important thing to think about right now, is that what you're doing is a little bit of investing, but mostly short-term trading / gambling. And that's what we have. To show me one of the ways I look at just how much liquidity has dried up is by looking at the bid offer size in the S&P futures, which used to be, before the world just fell apart, I would say, fair to say that you had at least a couple of hundred contracts on the bid and the offer side at all times, every tick. And sometimes you had over 1,000 contracts, but basically it was pretty rare to see less than 250 contracts per side. Right now, if we get much beyond 5 contracts per side, it's a lot. And that says to me how much this market is dried up. It also says to me And by the way, as I'm talking, and I realize we only have about 9 minutes left, I'm not sure we're going to get to all the other charts. But I think this, what I'm talking about now, might and probably is more valuable than looking at individual charts, because it's about explaining to you how you have to approach and think about trading a market that moves a year's worth of traditional value in hours. So, um, just lost my train of thought. Wow. Um, so when you're trying to manage risk, you really have to think about, is risk manageable right now? And I'll tell you, I don't think it is, because the moves are so huge that it's going to be very hard to pick how to play this, other than almost closing your eyes, buying at levels, and then hoping that those work. And I would tell you, traditionally, hoping something is going to work is not the way you want to invest. Um, Now you could wait for a whole bottom to develop, and and then there's all this talk on the business news channels. Are we going to have a V bottom, which hardly anybody's talking about now? That's kind of out the window. Are we going to have an L-shaped bottom, in the sense that market sells off and then, let's say, goes sideways for a while, building a base, and then starts to turn higher? Um, or will you ultimately, well, that's actually more of a U-shaped, so, down, sideways, and up. Or is this going to be an L-shaped market, which is, we trash the market, and then for a long, long time to come, we just kind of stay in ranges back and forth, and this market can't really advance. One of the things I notice here, just looking at this, I'm going to take the cloud off just because it'll be easier to see. But notice from the 2009 low, if we look at this move to the 2011 low as wave one, this whole move either to here or even to here is wave two, and then the very high angled, I'm sorry, not wave two, here, let me go back. Sorry, guys. Wave one, come down two, rally three, either call this a four or this whole thing is part of three, and the move down here is the four, and then a fifth wave that has completely fallen apart. So if that really is the secular high, then you expect an ABC at a minimum on the downside. So the question is, can you time where the A ends and the B begins? And what I'm saying is, I don't know for sure if this is it, but it's a place that we certainly can get some type of bounce from. And that was my thought in being a buyer earlier today. But it would also suggest that if this is the top of it all, then we're not going to take this high out for a long time, because then you've got a long time ahead of us to do an A, B, C, and then try to recover. Or is this going to be a 1, 2, 3, 4, 5, and it's no longer corrective, and this ends up being a secular high? I don't know. I'm in this business 40 years, and I can tell you, I don't know. I've never seen anything quite like what we're seeing now, and of course, the world has never seen anything quite like what we're seeing now. Because we're in a situation that, since markets traded, back 100 years ago when there was the Spanish flu, there really, I'm not saying there were no markets at all. Yes, there was a treasury bond that was tradable, but it's not like everybody was trading it. But there was a rate. There was no S&P 500 or Dow Jones, but there are implied ways of looking at what markets did. But the reality is, for all of us, this is hopefully a once in a lifetime thing, but we don't know how long it's going to last. And look, I'm recording this from my home. The kids are home from college. My wife is working from home. My internet stinks because I suspect everybody in the neighborhood is working from home with kids home, and everybody's on the internet. And I've had a lot of trouble just with the internet the last few days, and that could last for a while too. So look, we are in unprecedented times, and I suggest, panic does not help. The good news is that the banking system is in a heck of a lot better shape than it was in the debt crisis. So this market decline is not because of the system. This is mostly coronavirus led into a clearly slowing economy that we don't know how long it's going to last. And, several countries already in Europe having what I'll say, being in lockdown. I suspect in certain ways this is going to come to the U.S. where when I say, cities close, I don't mean that there's a guard at the entrance to the city saying, turn around, you can't come in. Although Manhattan may get like that, I don't know. But everybody's working from home. Spending is curtailed. Look at your 401k results in the last month, and I know, from where it was and where my 401k is now, I don't feel like spending money because what was paper gains is dramatically gone, and this is going to take some while to shake out. So I think the important thing to think about here is if you're going to put money to work, you really look at it in a sense of this needs to be an investment, and whether or not, and this is the big question that nobody knows, and there'll be people on TV or in the media being interviewed that will tell you that when we made this high, this is going to last for 10 years. You're never going to see returns in the market like you've seen. Maybe it's true. I don't know. What we do know is in the past, buying dips works. The question is this 2-month decline now the beginning of a much more substantial decline, and how long it'll take to recover? So I kind of get a kick out of when, here, now, let me just take some of these things away here. And so here is the entire data on a monthly basis of the S&P 500 going back to 1928. And if I put this on a log basis, which is probably the better way of looking at this, I don't know if this will even let me play with stretching it. Let's see. Yeah, we're not even going to be able to see the whole thing because almost. Let's see. I'm trying to get every bit of it in, and I'm not sure. Let's try a little more here. No, that's too much. There we did it. No, it slid. Okay. The point is, this is the market over time. So yeah, we get multi-year pullbacks. We saw that happen twice between 2000 and 2010. So we know that we can see dramatic declines of 50 or more percent. But when you look at these long-term charts, is there any doubt that over time you need to be in the stock market to make money in life? That it is the best long-term investment you can make. And even if we go into a near-term recession, which we probably will, and hopefully not a depression, if you have a time horizon of 20, 30, and 40 years, you want to be in stocks. So if you're a person in your 30s and 20s or even 40s listening to this, and you have 20 plus year time horizon, then yes, you look at key levels to kind of focus on that. If the market got back to, you buy. And part of this is, you close your eyes. But there's nothing that is going to do better over time than the stock market. And that's proven over 100 years. And if it's proven over 100 years, to me, that's pretty good. That's enough history. That's not like a 3-year thing. That's a long, long time to say you want to be invested in stocks for the long haul. So when, some of these professors get, it's just so sensitive to try to get this all in one. Oh, close enough. Nope. Anyway, when the business channels have professors on, there we go, saying, stocks for the long run stuff. Yeah, it's obvious. They're not telling you anything that isn't obvious. So that's it for this week. I hope this was helpful. I'm Rick Bensignor, and this is In the Know Trader.